Hello YouTube friends and welcome to Grow Money Seeds, a channel about building wealth and managing your money. If you are new to the stock market or trading in general, then the extent of your knowledge might be that if you are bullish and you think a stock's price will go up, then you can buy shares of a company and hopefully over time the price will go up and then you would sell them and make money. However, did you know that you can also make money if you think the price of a stock will go down? If you are bearish, you can short shares, and if the price goes down, then you would also make money. This effectively lets you trade both sides of the market. There's also an exciting derivative called options, which also allows you to trade both sides of the market. And this can offer you many advantages that regular stock trading cannot. Right, let's talk about this. Okay, so what are options? The definition of an option is that it is a contract which gives the buyer or the owner of the option the right, but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. Or, in simpler terms, an option is a contract to buy or sell 100 shares of stock at a certain price for a limited time. Let's look at an example to compare the buying of shares to the buying of options. If shares of XYZ are trading at $100 a share, and I think the price will go up, I could open a stock position and buy 100 shares of stock at a price of $100 a share for a total cost of $10,000. Looking at the payoff diagram for stocks, we can see that if the price goes up to $110, then I would have a profit of $1,000 and the position would now be worth $11,000, which is a 10% return on my investment. However, if I'm wrong and the price drops to $90, then I would have a loss of $1,000 and the stock position would be worth $9,000. Stocks give us a symmetrical exposure, which means that if the stock goes up or down by a certain amount, then my gains or losses also go up or down by the same amount. For the options position, I could buy a call option at the $100 price for the next 30 days. The contract's not free, and this may cost me $500, but this gives me the right, but not an obligation to buy 100 shares of stock within the next 30 days at a price of $100 per share. Let's look at the payoff diagram for a call option. If the price goes up to $110, this means that my contract is now worth more than I bought it for and may now be worth $700. I could sell the contract and make a $200 profit, or I could exercise the contract and take ownership of the shares at the strike price of $100. Selling the contract would give me a 20% return on my initial investment of $500, which is a far greater return than if I bought the stock. If I'm wrong and the price drops below $90 or less, then I could just let the contract expire and my maximum loss would be $500. Note, this is 50% less than the loss on the stock position. Options give us an asymmetrical exposure, where the gains and the losses do not go up and down by the same amount. On the flip side, if I think the price of XYZ is going to go down, then I could buy a put option. This is the inverse of buying a call option. Again, if the price falls, then I would make more money than a stock position. But again, if I'm wrong and the price rallies, then I would only lose the maximum of the premium that I paid for the contract, which is a much smaller loss than if I owned the stock. Why do we have options? The main reason we have options is for hedging or protecting stock positions. Buying a put option acts a bit like an insurance policy. Let's assume I buy 100 shares of company XYZ and the price of the shares tank. This would mean I could have a significant loss on that position and, at worst, I could lose the entire amount I invested. However, if I buy shares and I buy a put at the same time, then if the price falls, the shares lose value, but the put option increases in value, and this will reduce my loss. The put option will increase my effective cost per share, but it still leaves me with unlimited upside gains, and if there's a crash, the downside loss is limited. Another great reason for options is shorting the market. Shorting the market can be risky, as historically markets tend to trend upwards about 54% of the time. Therefore, anybody shorting the market has a statistical disadvantage. If I short 100 shares of company XYZ and the stock market rallies by 200%, I would be on the line for a 200% loss. If the price continues to rally, my losses could be unlimited. However, if I just buy a put option and the stock rallies, then my maximum loss is limited to the price of the put contract, and my gains to the downside are unlimited. Okay, so far we have looked at buying a call and a put option. But this is where things can get a bit more confusing, as you can also sell a call and a put option. The seller of an option is paid the premium for the option contract and is more interested about where the price will not go. There is an option compass that can help you work out the difference between buying a call and a put, or selling a call and a put. We will be discussing the differences between option buying and option selling in future videos. So this might be a good time to click on the subscribe button so you're notified when new videos are released. Now, I have probably painted a rosy picture of options, and making money with them sounds pretty easy. However, when it comes to the market, there's no such thing as a free lunch. Let's talk about how options are priced in a bit more detail, and why buying an option can actually have more risk than buying stock. How does the pricing of options work? The value of an option is generally made up of the probability of future price events. The more likely an options contract is going to do something, the more an option is worth. From our previous example, when we buy the call option and the stock price goes up, then the price of the option also goes up because it is more likely that it will be profitable. The more the option is in the money, then the more it's worth, and this is called its intrinsic value. The big problem when buying an option is that it's subject to time decay, which also affects the price of an option. The less time a contract has, then the less the contract is worth. This is because there's less chance the price will move in the desired direction. When buying an option, it is a wasting asset, and there's less value with each passing day. This is where the selling of an option and using time decay is advantageous. The time value of an option is called its extrinsic value. Therefore, the option premium is equal to the intrinsic value plus the extrinsic value. Why do we trade options? Options are an alternative to trading stocks. By trading different option positions or stocks with options, we can build various trading strategies. Certain combinations of options will allow us to make money if the stock price goes up, down, or just even sideways. In other words, we don't have to be right about the stock price direction to make money. Options are leveraged, and if understood and used correctly, they can actually give you better returns than stock and limit your risk. Option prices are based on mathematics, and this allows us to calculate the probability of profit and the risk and the reward before even placing a trade. So, quite literally, options give you options. If you found this video useful, then please don't forget to click the subscribe and the like buttons so you're notified when future videos are released. This would be much appreciated, and this will help my channel to grow and hopefully help others to achieve their financial goals. Thanks for watching.